We're going to move forward in this video and we're going to talk a little bit more about owner's equity transactions. And so hopefully you remember from the last video the 4 things that impact owner's equity. And the things that decrease owner's equity are when our company incurs expenses or when the owner takes a draw and takes money out of the business. On the other hand, the things that increase our owner's equity are revenues when we sell something or perform our service, and investments that the company may make. So what are revenues? Revenue is what we receive in exchange for selling our product or selling our service. Now, sometimes we may sell a product or a service, and that might not result in cash right away. So back to my example of the building supply store this morning, the building supply store sold some merchandise to the contractor standing in front of me. He didn't pay cash for it. He put it on his account. Now, just because the building supply company hasn't received money yet, they still have to recognize this as a sale. So they don't wait and see if he pays and then record the sale. So even though the sale is recorded, even if they haven't been paid for it. So as soon as it becomes a receivable, as soon as that transaction has occurred, whether it's cash or whether it becomes an accounts receivable for the business, it's considered revenue to the company. And that may be a tough concept because I think we think of revenue as money coming in, but that isn't necessarily the case. It is the sale of the product or service that results in the recognition of revenue, not the point at which the funds actually are received by us. Okay, so here are the examples of some things we may see in the form of revenue type transactions. This is just a brief example. Many more and a wider variety as we go on. And so now we're going to shift from revenue and look at what an expense is. An expense represents a decrease in an asset as a result of efforts made to produce revenue. What does that mean? Probably almost better if I move on to some examples. So an example would be rent, salaries, supplies consumed, taxes, utility bills, our electric bill, if I have to have something repaired, that's going to be an expense. Expenses, I think, are pretty basic concepts, and so I don't want to spend too much time trying to come up with examples because I think expenses are kind of self-explanatory. But where we're going to add another layer to it, I guess I should say, is when we look at the relationship that revenue and expenses have when it comes to net income. And so net income is going to be an important accounting concept that we will reach back and tap into time and time again as we go on in our studies. And so when we have revenues, in other words, our sales, whether or not we get paid for them or not, when our revenues are more than our expenses, then the surplus amount that's left over is what's known as net income. So in this example here, we have Luke Perkins, who performs $6,000 of tax services. He's a tax guy, and he's doing people's taxes, and he collects $6,000 in fees for preparing people's taxes. And he had expenses of $1,500 for rent, $500 for supplies, and $3,000 in salaries. So he had total expenses of $5,000. So if we look at his $6,000 in revenue and we subtract the $5,000 in expenses, that gives him $1,000 in net income. And why do we care? Just don't worry about why we care for a moment, because it will hopefully all gel at some later point. Now, the flip side of net income is net losses. And so we've got John Atwood, who performed $8,000 of delivery services this year, but he had expenses of $3,500 for rent, $500 for supplies, $3,000 in salaries, and $2,500 for gasoline. Sounds like one of my bankruptcy clients, frankly. So we've got revenue of $8,000, but he spent $9,500 to make $8,000. So he had a loss of $1,500. We regularly talk about accounting transactions in terms of accounting periods, and I know that I've made reference to that already. And so we can look at our accounting transactions on monthly, quarterly, or yearly bases. And so when we have an accounting period of 12 months, it's called a fiscal year. Why fiscal year? Well, we can begin with any month in the calendar and go 12 months from that point. And fiscal year is different from calendar year. A calendar year begins on January 1 and ends on December 31. On the other hand, a fiscal year could begin on any day of the year and end 365 days later. And that would be a fiscal year. So we looked at the relationship between, and we're still focused on equity accounts at this point. So we've looked at revenues, we've looked at expenses. Now we're going to look at withdrawals, otherwise known as draws. So when the owner takes money out of the business, it reduces his equity in the business. And that kind of makes sense. If he takes money out, he's got less value now. There's less skin in the game that he has in that business. And so again, this is referred to as a draw. We're going to look at an example here where we've got Rohan performed services and he received $500 in cash. So our business received $500 in revenue, which is an equity account, but we also received some cash, which is what kind of an account? An asset account. So we had two accounts that were impacted. We had revenue, which falls within the umbrella of owner's equity, and then we had cash, which is an asset. And those were both increased. So we had an increase in delivery fees of $500, and our cash also went up by $500. And if we look at this in terms of our accounting equation, we've got our cash over here. So we've got $500 in cash. Equals, we had no liability account impacted by this transaction at all. And we had $500 from the owner's equity side because of revenue. And so we remain in balance. Now let's look at what happened just on the asset side in terms of what our now total asset picture is. So we had $500 when we started this accounting period, if you remember from the prior transactions, and we now have an additional $500. So we have a total of $1,000 left, or now at this point in our accounting cycle. We still have the $2,100 in delivery equipment from what we had purchased before. So we have a total of $3,100 in assets. Now let's look at the right side of our accounting equation. We still owe $600 on that equipment we purchased. Remember, we bought it for $900. We made a $300 payment, so we still have $600 left. We have our owner's investment here that is still in his capital account. Now we made some revenue, which also falls under the umbrella of the owner's equity of $500. And so if we add together our liabilities and our equity, we come up with $3,100, which lo and behold equals the asset side of our accounting equation. And so now we have another transaction. And Rohan paid $200 for office rent. So how do we, again, characterize that in terms of what accounts were impacted by that transaction? So he had an expense for rent. And what did he use to pay that? He used cash. And our expenses, like our revenues, fall under the umbrella of owner's equity. Cash is an asset. So we know that we've impacted an owner's equity account and an asset account. Now, instead of both of them being increased or decreased, instead, we show an increase as a result of rent expenses that we've paid, and we have decreased our cash as a result of that transaction. And as your slide points out, be careful. When we incur an expense, it's going to increase an account, and that will result in an overall decrease in your owner's equity. And so we'll get to some better slides that hopefully will make this clearer. So owner's equity can be a little tricky in that way. But let's look at the transaction from our accounting equation perspective. We paid out our $200 in cash, and our owner's equity was decreased by $200. And so we balance. Even though the rent expense was an increase in expenses, that decreased our owner's equity. And I know that may seem confusing, but it will be okay, I promise. Now let's look at the asset side of our accounting equation and see where we're at. So prior to this transaction, we had $1,000 in cash and $2,100 in delivery equipment. We spent $200 paying our rent, leaving us $800 in cash. We still have our delivery equipment. So we have total assets of $2,900. And on the other side of the equal sign of our accounting equation, if we look at our liability, we still owe the $600 on the equipment. We didn't do anything about that. Our capital account remained the same. And I know I said it decreased, but hear me out, because this is really an umbrella of owner's equity. And so it's the owner's equity that had the decrease, you'll see. So we had revenue, which was 500, and we had expenses, which was 200. And so if we add up our liabilities and we subtract the expenses from the revenue, and remember these two numbers, our revenue and our expense, that's what's, remember, known as net income. So if we add our capital account and effectively what is net income, $300, to our liabilities, we have $2,900 on the right side of the accounting equation, which, lo and behold, equals our assets on the left side of the accounting equation. And so we remain in balance, which is good because we need to remain in balance. Now, Rohan paid $50 for phone service. So, what accounts were affected by that? Well, we know that we paid some cash out, so our cash was obviously affected, and that's an asset account. We had phone expense, which is again another expense account. So that's going to look just like our rent did. It increased the phone expense and decreased our cash. Those things happened on the opposite side of the equal sign. So we are still in balance. But let's look at what has happened to our assets now. So we started the period with $800 in cash and $2,100 in equipment. We spent $50 of that cash paying the phone bill. We didn't touch the equipment. So now we have $2,850 in assets. So now let's hop over to the other side of the equal sign and see what happened to our liabilities and our equity. Nothing. Now you may be saying to yourself, well, wait a minute. Why isn't the phone bill was something we owed? Why isn't that a liability? And the answer is basically we paid the phone bill as we incurred it. And so we consider that an expense rather than a liability. So we still have our $600 that we owe on our equipment. Our $2,000 capital account remains steady. We still only just have that same $500 in revenue, but now we have $250 if you add the rent we paid to the phone bill in expenses, and that gives us total on the right side of the equal sign of our accounting equation, $2,850. And I'm going to stop this video here, and we will move on to what happens if we get revenue on account.